I don't think there are good arguments against my position. I think the people that oppose my position are idiots. and
Today we are going deep into Charlie Munger's toolkit. We're not going to cover all the 100+ models that he talked about in his lifetime. Instead, we're going to focus on 5 specific mental models that are incredibly relevant right now. Tools that can help you navigate the market uncertainty, avoid common pitfalls, and keep your focus where it belongs, on the long term. More than magic bullets or market timing, it is about building a framework for rational decision making when emotions are running high.
And if the United States no longer wants to lead, Canada will.
If you're like a lot of retail investors right now, you might be feeling pretty anxious about your investments, wondering if you're doing the right thing, or maybe feeling pressured to do something, anything, just to react. It's completely understandable. This kind of uncertainty is very stressful. But there's a way to think about this turbulence, a way to approach your decisions that doesn't rely on panic or prediction. If we could borrow some wisdom from one of the greatest investing minds and sharpest wits of the last century, it would be Charlie Munger. I read his book, Poor Charlie's Almanack, 2 years ago and have gone back to it several times just to reread and be guided by his wisdom. So what exactly did Munger mean by mental models? At its core, a mental model is simply a concept or framework that helps explain how something works in the world. Munger was famous for drawing these models from a huge range of disciplines: psychology, economics, physics, history, biology, basically anywhere he could find a useful idea. He strongly argued against what he called the man with a hammer syndrome.
A case of what I always call man with a hammer syndrome. To the man with a hammer, every problem tends to look pretty much like a nail.
Relying on just one way of thinking, especially just the tools from your own profession, creates huge blind spots. Instead, Munger advocated building a latticework of mental models in your head. Imagine a grid where you just hang different useful concepts from various fields. It's about seeing the problem from multiple angles, which ultimately leads to better, more rational decisions. As Munger might imply, you need more than one tool if you don't want every situation to look the same, potentially foolish way. If you find this kind of analysis interesting, please give this video a thumbs up. It really helps the channel. And if you haven't already, consider subscribing for more deep dives into economics, finance, geopolitics, and current events. Our first tool today is deceptively simple but incredibly powerful: inversion. Munger absolutely loved this one, often framing it with his classic dark humor.
Charlie always says, all I want to know is where I'm going to die, so I'll never go there. So, yeah.
Applied to investing, instead of asking, how can I succeed or how can I make a lot of money in this market, inversion flips the question: what could I do to absolutely guarantee failure? Or what are the ways I could lose catastrophically right now? It forces you to identify potential pitfalls, the stupid mistakes, the paths that lead straight to disaster. Once you clearly see what not to do, avoiding those traps dramatically increases your odds of a decent outcome. Munger believed that avoiding stupidity is often easier and more effective than striving for brilliance. It's like trying not to fall off a bike. Seems easy, but requires continuous focus. This is incredibly relevant now because market turmoil breeds stupid mistakes. Fear and greed push us towards irrational actions. Using inversion helps us pinpoint those actions. A. Panic selling. What's a surefire way to lock in losses? Selling everything in a panic after a market drop. Inverting tells us avoid selling purely out of fear. B. Chasing speculative bubbles. How could I lose money quickly? By jumping into the latest hot speculative trend that I don't understand, especially when the market is shaky. Inverting says resist the FOMO on things outside your expertise. C. Taking on excessive leverage. What could wipe me out completely? Using borrowed money or margin to make big bets when volatility is high. A sudden drop could lead to margin calls and devastating losses. Inverting warns, be extremely cautious with leverage now. D. Making big rash decisions. How can I make a decision I'll regret? By reacting impulsively to headlines without careful thought. Inverting advises, slow down, think things through. So the actionable tip here is, before you make any significant investment move in this environment, buying, selling, or changing your strategy or position, grab a piece of paper and actively list the ways this decision could go horribly wrong. What are the absolute worst case scenarios? What actions would lead to those outcomes? Then consciously steer clear of those paths. Playing defense first, especially when the game gets rough, will help you avoid predictable failures. This next model is a cornerstone of both Munger's and Buffett's philosophy, the circle of competence.
What would you push in that direction if you've got a class full of finance students in college? Maybe what are a few lessons
I would teach to the people who can learn, and if the others couldn't keep up, the hell with them. Well, it can't be improved. I don't believe in butting my head against the wall.
It sounds very simple, but it requires real intellectual honesty. The idea is that everyone has areas they understand well, their circle of competence, and vast areas they know little or nothing about. The key to success, especially in investing, is to accurately define the perimeter of your circle and just stay within it. Munger wasn't saying you shouldn't learn new things, quite the opposite. He was a lifelong learner dedicated to expanding his circle, but he stressed the critical importance of knowing what you don't know and having the humility to admit it. Making investment decisions outside your circle of competence is like playing a game where you don't know the rules. The odds are heavily stacked against you. He was particularly scathing about areas he saw as deliberately obscure or speculative. He famously called complex derivative accounting practices an insult to sewage.
To say that derivative accounting in America is a sewer is an insult to sewage.
And his view on crypto was even more blunt.
And I think the people who are professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds and you decide I can't be left out.
Strong words, but they highlight his extreme aversion of operating outside a clear area of understanding. This is crucial in volatile markets because uncertainty breeds temptation. When familiar investments are down, we might be tempted by complex strategies, obscure asset classes, or hot tips in industries we don't truly grasp. If you don't understand the underlying business, the technology, or the risk involved, you're not investing, you're gambling. And volatile markets are a terrible time to gamble, especially in things Munger might equate to, well, you heard him. Sticking to your circle means a few things. Focusing on businesses and industries you can genuinely understand and explain. Resisting the allure of investments that sound exciting but are beyond your expertise or seem intentionally complicated. Being comfortable saying, I just don't know, or that's too complicated for me and I'm going to avoid it. So here's your actionable tip. Before you invest in anything, especially now, ask yourself honestly, can I explain how this company makes money? What are its cash flows? What is its competitive advantage? And what are the major risks? Simply and clearly to someone. If the answer is no, you're likely outside your circle. Either dedicate serious time to learning and bringing it inside your circle, or just stay away. Don't let market noise push you into areas where you're at a disadvantage or where the accounting might smell worse than sewage. Okay, so we've talked about avoiding mistakes, inversion, and knowing your limits, circle of competence. Now let's talk about finding potential opportunities amidst the chaos using another classic Munger and Buffett principle, the margin of safety. This concept, originally made popular by Benjamin Graham, is fundamental to value investing. It means only buying an investment when its market price is significantly below your estimate of its underlying or intrinsic value. Think of it like building a bridge. If you calculate that you need a bridge to hold 10,000 pounds, you don't build it to hold exactly 10,000 pounds. You build it to hold maybe 20,000 or 30,000 pounds. In investing, the margin of safety is the discount between the price you pay and the value you estimate you're getting. This buffer protects you against errors, bad luck, or further market declines. Munger was all about understanding the real earnings and value, often expressing contempt for metrics designed to flatter results. His most famous dismissal was reserved for EBITDA, earnings before interest, taxes, depreciation, and amortization.
Charlie?
Yeah, I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings.
His point was that ignoring real costs like interest and taxes paints a misleadingly rosy picture, something you absolutely cannot afford when demanding a margin of safety. Munger also helped shift Berkshire's focus towards buying wonderful companies at a fair price rather than fair companies at rock bottom prices. The reason why margin of safety is paramount right now is because market downturns driven by fear can cause the prices of even wonderful companies to fall significantly, potentially allowing for that very margin of safety to keep your investments from not going underwater. Earnings multiples were at an all-time high in the last 12 to 18 months. The AI euphoria made many sensible investors get the FOMO, meaning if you got in during that period, your margin of safety was lower than usual. When others are panicking, prices can become detached from underlying value. This aligns with Buffett's advice to be greedy when others are fearful.
If you have a temperament that when others are fearful, you're going to get scared yourself. You are not going to make a lot of money in securities over time in all probability.
But you need to always tread with caution. Munger absolutely believed that market downturns were infrequent opportunities, but only if you bought quality assets, understood the real earnings, and demanded that safety cushion. Your actionable tip from this is shift your focus from simply the price to the value you are getting for that price, scrutinizing the earnings quality. During downturns, it is worth actively looking for high-quality businesses within your circle of competence that might be trading at a significant discount to their long-term worth, due to fear, and whose earnings aren't overly flattered by accounting tricks. Don't just buy something because it's down. Buy it because it's down and offers substantial, honestly calculated margins of safety. Here's the next one: psychological resilience. This might be the most important model of all, especially when markets are going haywire. Munger was often a master student of human psychology, recognizing that our own minds are often our worst enemies as investors. Building psychological resilience means understanding and counteracting the powerful cognitive biases that lead us astray. His explanation for Berkshire's success often came with a wry observation about others.
Warren, if people weren't so often wrong, we wouldn't be so rich.
Yeah. He's finally explained it to me. Okay.
Staying sane and rational when others aren't is a massive advantage. Munger emphasized recognizing biases like confirmation bias, seeking information confirming our beliefs, social proof or herd mentality, feeling safer doing what everyone else is doing, even if it's panic selling. Loss aversion, feeling losses more strongly than gains, leading to poor selling decisions. Availability bias, overweighing recent, vivid news like scary headlines. Why is mastering psychology vital now? Market volatility amplifies these biases. Fear dominates logic. Munger knew that investors who cannot handle these psychological pressures essentially deserve the mediocre result they often get. Building resilience involves awareness, knowing that these biases exist, process over outcome, focusing on rational decisions based on your plan, not short-term prices, seeking disconfirming evidence, actively challenging your own beliefs. Your actionable tip today is when you feel the urge to make an emotional decision, please stop, pause, ask yourself, why am I feeling this way? Is this decision driven by logic and my plan, or by fear, headlines, or the herd? Is my expectation realistic, or should I perhaps lower it a bit, Munger style? Recognizing the bias or managing expectations is often enough to regain perspective. Our final Munger tool ties everything together: long-term thinking and patience. Munger deeply understood the power of compound interest, calling it one of the most important models. But compounding only works its magic over long stretches of time. It requires patience and the ability to endure the inevitable ups and downs. He famously said, "The big money is not in the buying or the selling, but in the waiting." He knew significant market downturns were normal. His advice wasn't panic, but to just stay committed. He maintained remarkable perspective, even joking about his own mortality to make a point about enduring temporary troubles.
I am optimistic about life. If I can be optimistic when I'm nearly dead, surely the rest of you can handle a little inflation.
This long-term optimism was grounded in rationality and the belief that over time, value prevails. He also believed in earning your success through sound principles.
Luckily, I got at a very early age the idea that the safest way to try and get what you want is to try and deserve what you want. It's such a simple idea. It's the golden rule, so to speak. You want to deliver to the world what you would buy if you were on the other end.
Patience and rational long-term investing are part of deserving good outcomes. Why is this perspective critical now, though? Because short-term volatility feels incredibly important. Daily swings and scary news hijack our attention. Long-term thinking provides the antidote. It reminds us that market declines are normal and historically temporary. Successful wealth creation is typically a marathon. Your focus should be on your goals years from now and not today, tomorrow, or next month. And your actionable tip on this is when market turmoil makes you anxious, consciously pull your focus back to your long-term financial goals. Ask yourself, does this volatility fundamentally change long-term prospects of my sound investments within my circle of competence? Does it change my need to save for distant goals? Usually, the answer is no. So review your plan, remind yourself why you invested, and cultivate the patience Munger championed, the patience to wait, let compounding work, and endure the storms. Perhaps with a dose of his resilient, slightly morbid optimism. And if you thought that Trump is different and the world is falling apart, the world has fallen apart previously as well. So analyze the situation and see what is best for you. Thankfully, these are not complex financial formulas, and they're just simple frameworks for thinking clearly and rationally, especially when emotions threaten to take over. Munger's core message, woven through all of these models, is about discipline. The discipline to prepare, to be rational, to admit ignorance, to control emotions, and be patient. I hope these insights from Charlie Munger provide some valuable perspective to you and maybe a chuckle or two during these uncertain times. Which of these models or maybe which Munger quote resonates the most with you right now? Let me know in the comments below. Thank you so much for watching. Stay rational, stay patient, and as Munger might say, try not to do anything too stupid. I'll see you on the next one and have a great day.